If you're enrolled in a qualifying high-deductible health plan, you're eligible for the single best structured tax deal in the U.S. retirement toolkit. Most coaches who have access to it either don't max it out or treat it like a flexible spending account and spend it down every year on current medical bills, or both. That's worth reconsidering because the HSA achieves something no other U.S. retirement adjacent account achieves, and the long game discipline that captures that advantage is unglamorous but easy to set up. What makes the HSA different from every other tax-advantaged account? Traditional IRAs and 401ks are deductible going in and tax-free growing, but taxable coming out. Roth IRAs and Roth 401ks are tax-free growing and tax-free coming out, but you fund them with after-tax dollars going in. The HSA is the only one that's deductible going in, tax-free growing, and tax-free coming out for qualified medical expenses. 3 tax advantages in one container simultaneously for one specific use case. That's what makes it different. The eligibility gate has 2 requirements. You have to be enrolled in a qualifying HDHP, and you cannot be covered by Medicare. HDHP qualification is defined by minimum deductible thresholds and maximum out-of-pocket limits set annually by the IRS. Your plan qualifies if it meets both conditions: deductible at or above the minimum, out-of-pocket cap at or below the maximum. The thresholds change each year with inflation. The 2026 numbers come from IRS Notice 2026-05 and are on the next slide. 2026 HDHP thresholds. Self-only coverage, minimum deductible $1,700, maximum out-of-pocket $8,500. Family coverage, minimum deductible $3,400, maximum out-of-pocket $17,000. Your plan qualifies if both conditions are met simultaneously. If your deductible is below the minimum, no HSA eligibility, even if the out-of-pocket cap is fine. If your out-of-pocket cap is above the maximum, no HSA eligibility, even if the deductible is high enough. Both gates have to swing open for you to contribute. 2026 HSA Contribution Limits. Self-only HDHP coverage, $4,400. Family HDHP coverage, $8,750. Age 55 plus catch-up if you're not yet on Medicare, $1,000. The catch-up is set by statute, not indexed for inflation. It's been $1,000 since 2009, and unlike the Secure 2.0 IRA catch-up that's now inflation indexed, this one stays flat until Congress changes the statute. Numbers smaller than a solo 401k ceiling, but the triple tax structure on the next slide is what makes the dollars work harder than they would in any other account. Walk the triple tax advantage one move at a time. Move 1, deductible going in. HSA contributions are an above-the-line deduction on your personal return, available even if you don't itemize. For a self-employed coach funding from after-tax business income, the deduction is immediate against current year income. Move 2, tax-free growth inside the account. Investments inside the HSA grow without federal income tax or capital gains tax, exactly like inside a Roth IRA. Move 3, tax-free out for qualified medical expenses, whether you withdraw now or 30 years from now. 3 tax advantages, 1 container. After age 65, the HSA quietly becomes a stealth traditional IRA with 1 extra benefit. The qualified medical expense restriction on tax-free withdrawals disappears for non-medical purposes. Non-medical withdrawals are taxed as ordinary income, exactly like a traditional IRA distribution. Any medical withdrawals still come out tax-free, which the traditional IRA can't match. There's no downside case after 65. The worst the HSA does is function like a traditional IRA. The best it does is keep delivering tax-free withdrawals for medical expenses you'll definitely have in retirement. Here's the long game discipline that most HSA holders never practice. Don't spend the HSA down every year on current medical bills. Pay current medical expenses out of pocket from other cash flow, business or personal. Let the HSA compound untouched year after year with full triple tax treatment working on the balance. There's no deadline on when you submit qualified medical receipts for reimbursement. Keep the receipts indefinitely and reimburse retroactively whenever you want, or wait until 65 and withdraw for any purpose a traditional IRA tax treatment. The HSA as retirement vehicle, not as medical slush fund. One honest caveat before this unit closes. The HSA only works if the HDHP underneath it works. The plans are linked by IRS definition, and the cheapest premium can still be the wrong premium once you model actual utilization. 2 children with recurring specialist visits, an ongoing prescription, an aging parent on your plan, the deductible math flips, and a mid-tier PPO can come out ahead even after the lost tax shield. Module 14.4 walks the side-by-side. The framing here is conditional. When the HDHP is the right plan, the HSA is the highest value tax move available to a self-employed coach. The conditional matters. 2 questions before you close this unit. 1. Does your current health plan qualify as an HDHP? Check the deductible against $1,700 for self-only or $3,400 for family, and the out-of-pocket cap against $8,500 self-only or $17,000 family. Both conditions have to be met. 2. If your plan qualifies, is your HSA open and current year contributions maxed, or at least funded as far as cash flow allows? If your plan qualifies and you're not contributing to an HSA, you're leaving a triple tax advantage contribution on the table. What you invest inside the HSA, cash, mutual funds, ETFs, is your fiduciary.